Top 10 Investors Who Lost a Fortune and How. Even the most astute investors are susceptible to catastrophic losses. The stock market is a high-stakes battlefield where fortunes are made and just as swiftly lost. Whether as a result of risky wagers, market crashes, or unexpected economic shifts, some of the world's most legendary investors have fallen victim to staggering financial collapses. These stories serve as potent reminders that no one is invincible in the world of investing, from billionaires who misjudged their moves to financial icons who were brought down by scandals. Here are 10 renowned investors who lost a significant amount of money, along with the circumstances that led to their downfall. Jesse Livermore. Jesse Livermore's narrative is ultimately one of tragedy. Despite his pioneering role in the field of stock trading, his greatest success occurred during the 1929 collapse, when he aggressively shorted the market and amassed a staggering $100 million. This amount is impressive even today, let alone for the time. However, Livermore's mental health was significantly impacted by personal issues, despite his brilliance. To exacerbate the situation, the Securities Exchange Act of 1934 implemented new regulations that significantly disrupted Livermore's operations. George Soros. In 1992, Soros, who is renowned as the man who broke the Bank of England, achieved $1 billion by shorting the British pound, a well-known maneuver that became known as the Black Wednesday trade. However, he has also encountered some severe setbacks. For instance, he anticipated a market decline following Donald Trump's election in 2016 and subsequently lost approximately $1 billion by betting against US equities. The market experienced an increase. However, the dot-com bubble collapse in early 2000, resulting in Soros's loss of billions, was perhaps more significant. Soros, like many others, had made substantial investments in technology stocks. However, his empire was also destroyed when the bubble fell. Well, not quite, but he did incur a substantial loss and was compelled to restructure his entire investment strategy. Bill Ackman. Bill Ackman, the founder of Pershing Square Capital Management, made a significant error by investing significantly in Valeant Pharmaceuticals. In 2016, Ackman's organization acquired an 8.5% stake in the organization. However, it encountered substantial controversy. An investigation by the Securities and Exchange Commission ensued as a result of notorious allegations of drug price profiteering, questionable accounting practices, and even fraud. In the aftermath of the controversy, its stock experienced a 90% decline, and its name was rebranded as Bausch Health Company. During this period, Ackman divested himself of his complete Valeant stake, resulting in a loss of more than $4 billion. Carl Icahn. This billionaire investor amassed his wealth by assuming control of underperforming businesses, reducing expenses, and compelling management to enhance efficiency to benefit shareholders. Consequently, he earned a reputation as a corporate raider, particularly after the hostile acquisition of Trans World Airlines in the 1980s. In May 2023, however, his fortune was partially destroyed when Hindenburg Research accused Icahn of operating a hazardous financial structure and overvaluing his assets, such as paying an unsustainable dividend to shareholders. Isaac Newton. Yes, Isaac Newton lost a significant amount of money trading stocks shortly before he died in 1727. In the early 18th century, the South Sea Company was a British trading enterprise that possessed a monopoly on trade with South America. This was the Nvidia of its era, receiving extensive promotion as a profitable investment, with a stock that was on the rise and had no limit. Newton earned thousands of dollars with the organization. However, the South Sea Bubble, which occurred in 1720, was a consequence of investors' realization that the organization was unable to substantiate its exorbitant stock price. John Meriwether. In the financial community, this individual and his organization, Long-Term Capital Management, are notorious. In 1994, John Meriwether established LTCM after working at Salomon Brothers. The hedge fund earned a substantial amount of money in a brief period as a result of its risky investments in government bonds, complex modeling, and heavy borrowing. However, the latter resulted in their downfall, as both Asia and Russia experienced a financial crisis in the late 1990s. The markets experienced a significant surge, investors ceased to place their faith in government bonds, and LTCM's losses escalated to $4.6 billion. Michael J. Saylor. Michael J. Saylor, the co-founder and CEO of MicroStrategy, was one of the most significant victims of the dot-com crisis. In the late 1990s, the company's stock experienced a significant increase in value as a result of the widespread enthusiasm for technology, and Saylor became a billionaire. However, in March 2000, MicroStrategy was compelled to restate its financial results and was accused of securities fraud. The dot-com bubble crash was precipitated by these events, which led to the collapse of its inflated stock. In the aftermath, Saylor suffered a loss of approximately $6 billion. Ray Dalio. Bridgewater Associates, the world's largest hedge fund, was established in 1975 by this Harvard alumnus. Therefore, it is evident that he is performing a commendable action. However, this was not always the case. Dalio placed a substantial wager in the early 1980s, asserting that the U.S. economy was on the brink of collapse. Nevertheless, his assessment was entirely inaccurate. Bridgewater was nearly insolvent. The economy experienced a surge, and Dalio suffered a complete financial collapse. He was compelled to terminate all of his employees and operate the company from his modest apartment, simultaneously borrowing money from his father to maintain electricity. Bill Hwang. Bill Hwang suffered a loss of more than $30 billion in a mere 10 days. We should retrace our steps. Archegos Capital Management was managed by Hwang, who employed a high-risk trading strategy known as total return swaps to accumulate a substantial fortune. In essence, he maintained Archegos's secrecy from regulators by borrowing significantly from banks, placing substantial bets, and allowing the banks to retain the shares. In summary, Hwang's entire portfolio collapsed to the extent of $20 billion. The banks panicked and liquidated positions, and the stocks he owned plummeted. Losses of up to $10 billion were also sustained by the institutions that provided financing to Hwang. Masayoshi Son. Look no further than Japanese investor Masayoshi Son for a dramatic tale of stock market tribulations. The tech collapse of 2022 had a significant impact on Son and his SoftBank group, as they made poor investments in failed startups such as Katerra and WeWork. This led to a valuation loss of roughly $30 billion for SoftBank. However, that is insignificant. In the late 1990s, Son made substantial investments in a variety of internet companies, such as Alibaba and Yahoo, which resulted in a significant increase in the valuation of SoftBank. The bubble burst in 2000, and, like many other companies of the era, this valuation plummeted to the ground. SoftBank's market value plummeted by 93% in a single day, and Son personally suffered losses of approximately $70 billion.